Hello and welcome to this special webinar from Fat Profits, the Next Millionaire. My name is Roger Malik. I'm the host for today's webinar and the head of client services. Joining me today is a special guest, Colin Dransfield, our senior account manager. Colin, welcome to today's webinar. How are you?
I'm very well, Roger, and hello and welcome to all the viewers today. We're all set for a great webinar, so look forward to proceeding with you on the webinar today.
Excellent. Thank you, Colin. Just quickly introducing a little bit about Fat Profits. Some of you are probably familiar with some of these names or faces. Our most familiar face you probably have seen is Angus Geddes, our founder and CEO of Fat Profits. We've been running for 23 years, and Angus is very popular in the stock markets. We also have our resource analyst, David Lennox. He's an absolute genius when it comes to mining. We've got our equity analysts, Andrew Blackmore and Gary Burton. And of course, then you've got myself and Colin in today's webinar. But before we get into today's discussion, a bit of housekeeping first. This presentation from Fat Profits is general information only. We don't provide any personal advice. If you're looking for that, please see your financial advisor or planner. And also, past performance is not a reliable indicator of future performance. And today's webinar, we will try to make it as interactive as possible. So you are welcome to ask questions about the stock market or any particular stocks we are discussing. And you can type those questions where you see the orange arrow, and we will get to those as quickly as we can. So over to you, Colin. We are talking about the next $1 million plus to be made in the stock market. And today we have a lot of topics to cover. So over to you, Colin.
Yeah, thank you, Roger. It's many topics today, packed full of issues. So let's quickly run through them. We'll cover banking issues, very topical at the moment, commodities, real estate, that's a sector to watch. Bitcoin, very interesting sector. Then we'll have a look at cash, dividends, and the recession, the impending recession. And what's the plan for 2023, 2024, Roger?
Absolutely, lots to talk about. So over to you. Maybe we'll start off with the banks first, Colin.
Yeah, look, this is a very interesting story, Roger. This is a very recent occurrence. And as the slide says, the Silicon Valley Bank collapsed following a run. Just in a nutshell, this bank invested in US Treasury bonds at a very low interest rate in a time of rapidly rising interest rates. What that meant is the bonds lost value over time. They lost significant value, caused a liquidity crisis, which caused the collapse of the bank. Previously, Roger, Washington Mutual was the largest bank to fail prior to the Silicon Valley Bank. This Credit Suisse is also a fascinating situation. Its big brother, UBS, with the assistance of the Swiss regulator, has bought out Credit Suisse. So it's a massive banking conglomerate now in Switzerland. And so that's actually a good thing for Switzerland and the banking industry. And we see some stability coming back into the banking system now in Switzerland. Regional banks, well, I think the thing to note here, Roger, about regional banks getting into a crisis, this banking crisis in the US is not for major metropolitan banks. It actually had its origin with regional banks. We've seen some reorganization of regional banks. There's been some help with the regulator. And as with Europe, we see calmer waters ahead, and we see things settling down nicely in the banking industry now.
Yeah, absolutely. So you look, as you can see in the charts here, the regional banks were doing fine post 2020. However, the recent big sort of crash, if you like, has pulled the value right out of the regional banks. Having said that, we don't think it's a crisis which will bring another GFC 2.0. However, it's important to note how the big banks are faring versus the regional ones. And look, what's caused it really, Colin, is the rapid rate rises, as you said earlier. We've gone from nearly 0% up to 5% now in the US. And while the big banks have actually held up pretty well, but some of the mismanaged banks, they haven't been able to catch up with the rate rises. and that's caused some issues. Now, part of that is also the junk bond defaults have now eclipsed in the last quarter because of this credit crunch they're now being faced. Has actually gone up dramatically versus the last 2 years. If you look at this column, I mean, the last column on the extreme right-hand side, that's the last quarter, and the volumes of defaults on corporate debt has actually climbed in the last quarter versus the last 2 years in total combined. So that's put us, or at least the Federal Reserve, in a pretty tricky situation. So what are your thoughts there, Colin?
Yeah, exactly right, Roger. This is a very unique set of circumstances. We don't see this very often in the economic cycle, and so they really are, the Federal Reserve, that is, between a rock and a hard place. And Roger, that's very true. The comment that you made about banks investing their reserves in US Treasury bonds at record low interest rates, as interest rates then rise, and they have risen rapidly, then the coupon rate, or the value of the bond, if you like, becomes less valuable. It's caused a massive problem in the banking industry. But further than that, we've still got very sticky inflation, Roger. We've got quantitative tightening now, which is there's less money being pumped into the economy. So they really are in a bit of a curly one. And just finally, the final point on all of this about the Fed, they really are the architect of their own dilemma, Roger, because several months to a year ago, they referred to inflation as transitory. That's really come back to haunt them. And that was a very bad call. And now they've got, some sticky times ahead, but we'll wait and see how it plays out.
Yeah, you're right, Colin. So yeah, look, they did tell the market they're not going to raise rates for a very long time. Unfortunately, they've had to now backtrack. However, now we're going to talk about what's ahead, because on one side they've got the banking crisis. They're trying, stem the flow or the outflows. But on the other hand, they've got inflation to worry about. Now, so far in 2022, most of you would remember, as Colin just pointed out, we had QT, which is quantitative tightening, and they've been reducing their balance sheet to try and take money out of the economic system. And you can clearly see that money was, being reduced. But recently, because of this mini banking crisis, they've had to inject billions of dollars to try and stave off 3 banks which have failed in the US. And potentially they might have to plug a few more, but it's probably going to be very limited. But that has not helped matters, because now they've had to pump some more money back into the economy. But this is the big driver of the share market currently, and this is very, very interesting, is if you look at the sector rotation that has taken place from March 8th, when the first news of Silicon Valley Bank came through, we have seen a huge rotation in sectors. And this is just to highlight a few key points here. Now, if you look at the bottom of this chart, you see financials, of course, have taken a big hit, 11% down. Energy, which was the best performer last year, is down because of worries about a recession, 7.5%. Real estate has taken a hit. Materials, which have performed very well last year, have also taken a hit. And industrials, I might add, are not looking as healthy. But on the other hand, what has the money gone into? Well, technology. Tech stocks, which is NASDAQ, has had a huge inflow of money, especially you look at companies like Meta, Apple, and so on. Communication services and utilities have also seen a huge flow. When that happens, that's usually defensive play, and that's really what the market is saying, is they're flocking into defensives. And what this also leads us into is the market is now looking at 2 things for this year. One is earnings. And if you watch any bit of news channels, you will notice that majority of the economists are now starting to predict that the earnings is the key. If the earnings start to come down, the stock market will follow. And recession. Some are saying we are going to see a recession in the next 2 or 3 quarters. Some are arguing that economy is pretty strong. We're not going to see that now. Time will tell, of course. But here is what the market is looking at. Now, we don't, at Fat Profits, we don't go by gut feel. We don't go by what news channels are saying. We go by research. And part of the research that we must do is look at what the market is pricing in. Now, first thing, you look at earnings. So far, in these first 3 quarters, earnings have come down slowly but surely. First quarter 23, expectations are that earnings will come down a bit further, but then the remaining 3 quarters, the expectations from the market is that earnings will then start to go back up because they're expecting the Federal Reserve to start cutting rates and pump the money back into the economy. That's the expectation at this point in time. Now, if that doesn't happen, what will happen to earnings? Earnings will continue to slide because there's no rate cuts coming. So that could be a problem. The second thing is that the GDP, which is the health of the economy, so far has come down in the last quarter. You can see 0.9%. Expectation, the next 2 quarters will be positive, followed by a reversal, but still no pricing of a recession. Our worry is what if this is wrong, and what if in the next 2 quarters we see a contraction in the economy? Because if the Federal Reserve really is the architect here, if they don't cut rates, then we are going to see earnings come down and the GDP numbers go down, and that will be quickly repriced by the markets, and we are going to see further downgrades in companies' earnings. Now, this chart is actually quite interesting, Colin, because this really shows the last 20 years, 30 years of history of Federal Reserve rate cuts versus what happens with the market. How does the market respond? So you might find this very interesting because the blue line is the Federal Reserve rate rises, and the orange line is the S&P 500. So let's have a look here. Before the 2000 crash, we saw the Federal Reserve was raising rates, then they paused. The markets were responding positively because the markets were still going up. When they started cutting rates, and this is when the first rate cut arrived, you saw the markets then started to go down and down and down. We saw a 45% drop in the markets in the following 12 months because the economy was looking quite sick. That's why they had to cut rates. Fast forward to 2005 to 2007, rates were rising and rising, then they paused and the markets continued to go higher. And then came the first rate cut because the economy was looking sick, and then they kept cutting and cutting, but that did not stop the markets going down. And we saw a 58% drop in the markets, GFC as we know it. And before we then saw 0 rates for the longest time ever, for close to 10 years, and the market benefited from that. Fast forward to today, we've seen rate rises, as we talked about earlier. However, what we're seeing is the markets are already priced in. Last year, we saw a 20% drop in the markets. This has not happened previously. Markets have now anticipated, the worst things to come. However, the rates have not paused yet. We might see another rate rise, perhaps. Who knows? But the expectation is that the rate cuts will come. Now, if they don't come for the rest of this year, then what's going to happen to the share price on the stock market? We expect that the stock market will continue to come down. So over to you, Colin, because volatility presents some opportunities. What are your thoughts there?
Well, that's exactly right, and you described that last chart beautifully in terms of the relationship between falling interest rates and falling market values, and I think you described that perfectly. And so for all investors and short-term traders, long-term investors alike, market volatility does create a tremendous investment opportunity. It's a fairly basic principle of buying in the low, and the way we describe it is that we should position our portfolio with a good cash component so that we can buy undervalued stocks on the dip as the market bottoms. And we know that in the ensuing 12 months after a market bottom, Roger, after studying many, many share market cycles over the last 40 to 50 years, we know that the returns in the ensuing 12 months after the market bottom are somewhere between 35 and 40%. So, Roger, we've been guiding members and investors for several months now to position their portfolio with a good allocation of cash. Typically, you can do that by taking some profits off the table. Members have done that. We do recommend around about at least 25% in cash. Other members are in 50%. Here at Fat Profits, we're somewhere between 25% and 50% in cash. And by having that good allocation of cash, you do have that flexibility. You're nimble. You can respond to those undervalued stocks. You can look at the good sectors that we believe will perform well, and then the stocks within those sectors, and then away you go, Roger. That's a tried and true method of investing at the bottom of the market.
Absolutely, that's what you look for. Now, a quick look at the S&P 500 before we look at the ASX. Well, we know that S&P last year dropped 20%. This year so far, it's about 3% higher. What are we expecting? Well, if all things line up, I mean, there's a lot of water to go under that bridge over the next 6 to 12 months. But if things line up as our research suggests, and if Federal Reserve really hold and dig their heels about rate cuts for the rest of 2023, we think that the S&P 500 will bottom out somewhere between 3,000 to 3,400, which is another 20% drop, and that will present a fantastic buying opportunity. Now, if that does happen, what that will create is a whole lot of the next millionaires, and that's the title of today's webinar. Is do you position yourself currently? Are you ready to make the next 1 million, 2 million, 3 million, whatever it might be, from the opportunity that could present itself? Nobody's guaranteeing that will happen, but if it did present itself, are you in a position? I think that's the key message. But moving on to Australia now, just a quick catch up here. We know that the Reserve Bank is currently sitting on 3.6% cash rate, and the likelihood of that being paused now are very high because the inflation numbers are starting to slow down. We've seen recently inflation has dropped to 6.8%, and the expectation is the retail sales have also come down a bit, and maybe we've seen the peak of inflation. So if we see a pause, what's going to happen on the ASX 200? So we've seen that come off from nearly 7,600 points earlier in the year down to about 7,000 points. And we've seen last year, we've seen the lows of 6,400. Are we expecting the markets to drop to around 6,400? Very likely, especially if the US markets drop 15 to 20%. We think, we will catch a cold and we will go down to sort of similar numbers. However, we're more positive on the ASX than we're in the US market. Our exposure to materials, our strong financial sector, which is a big part of our index, will hold us up better. However, if we get down to 6,400 points, we think that will mark at the bottom of this bear market, and we will be ready and willing to deploy cash at those levels. Now, Colin, planning is important because you used to be a financial planner, so you know all about planning. Tell us more about what we're going to be planning today.
Well, thank you, Roger, and I do appreciate that. I was actually a financial planner for about 15 years, self-employed with AMP, and my practice was here in the city. So I do know a fair bit about planning, and proper planning prevents poor performance. That's the 5 Ps. If you fail to plan, you then plan to fail, and so we just need to position ourselves as investors with a decent plan, and the best way to do that is to sit down firstly with a watch list. I'm just going to talk about quickly the allocation. The allocation relates to cash, commodities, real estate, financial, dividends, and Bitcoin. They're the various asset classes that you can deploy your investment capital into. And the idea is cash is king in a crisis. Cash me up. And Roger, there are some members, believe it or not, who are sitting in 95% cash. And those investors are very astute. They've been through these share market cycles before. They're looking to turbocharge their investment returns in the next 2 to 3 years in this, what we believe will be a long and sustained bull run. Now, if you contrast that, Roger, to other investors that are a little bit back on their heels, they're not really planning. I know some members and investors, well, they don't have much cash at all. So you've still got time to cash up, take some profits off the table, increase your cash position so you can buy those wonderful undervalued stocks on the dip.
Absolutely. Look, as you said earlier, Colin, fat profits, we're sitting on roughly between 25 and 30% cash. So It's not excessive, but it is substantial, given that Angus is managing over $200 million in the managed funds, and that's all that he can do as a fund manager. Now, as a retail investor, we've got over 350 people attending this webinar right now. So I guess a lot of you probably are sitting on some decent levels of cash. I mean, ask yourself the question, how much cash are you sitting on, and what are you planning to do with that? Is it 25 to 30%? Is it higher? If it's too less, well, maybe you might want to consider a bit of a general guide to bring it up to that level. If it's on the higher side, maybe 40, 50, 60% cash, or even up to 100% cash, well, that's really up to you, but the opportunity will present itself, no doubt, in our opinion. So that's one area to look at. Second area, in our opinion, is to look at commodities. We do think commodities have a role to play in your portfolio. We are in a super cycle in commodities, and super cycles have only happened 4 times in the last 100 years. They last up to 5 years at a time, and they provide fantastic gains across mining. Now, one of the key commodities that we look at fat profits is gold. Now, if you have already got some gold, whether it's physical gold or mining companies, then you may be sitting on some gains over the last few years. But let's have a look at first US dollar gold price. You can see on the chart here the last 3-4 years, it has hit over $2,000 nearly 3 times. So this was back in 2020 when COVID happened. We've seen 2022 when the Ukraine war was announced, and recently we've seen when the banking crisis was announced as well. So 3 times in recent history, we've seen gold shoot up. Now, we've also seen some pullbacks along the way, but if you look at the Australian dollar gold price, because the weakening of the Australian dollar, we have now seen a record gold price for Australian gold producers. It's now just shy of 3,000 Australian dollars an ounce. Now, this is absolutely phenomenal. This has never happened in history. So we're looking at opportunity here. And one of the key things to look at is there's about 6 to 8 gold producers in Australia who are very well leveraged, and we will give you one of them today. The company's name is Northern Star NST. We've got a buy rating on this stock right now. So if you're still looking on the hunt, well, here's a free stock for you for watching the webinar today. This company is one of the largest gold producers in Australia. They have a couple of fantastic mines in WA. They've got excellent cash flow, world-class assets, over 6,000 people deployed in their business. They're a top 50 ASX company. And if you want to look at their results, this chart here shows you clear outperformance versus the index in gold. So you look at a number of ETFs here, which have underperformed over the last 12 months, including the S&P 500, Dow Jones, ASX, FTSE, whereas Northern Star has produced over 25% return at the same period, while also paying a good dividend. Then if you look at the current earnings, the cash flow, the buyback they've also announced, the dividend which they're paying, that is all healthy sign. And finally, looking at the share price performance, you will notice that early bird catches the worm. We got into Northern Star very early when they were still a young explorer, and you can see that around 43 cents many years ago. And we bought it multiple times along the way, and we, bought on the dips as well. This has seen highest of about $17, has pulled back to under $7 last year, which was a fantastic buy if anybody got in there. Now it's just shy of $12. We still feel there is value here, and if gold continues to hover around $2,000 US an ounce or higher, we see Northern Star going back up to its previous highs of $17 and even take them out in the coming months and years. Now, final point to make, and Colin, maybe I'll pass it on to you, because $10,000 invested in Northern Star all those years ago would be now $160,000. So that's 16 times your investment. And we're talking about how to become a millionaire. Yes, if you find one good stock, you have lots of patience, you do your research, you can turn $10, $20, $30, $50,000 investments into 10 times, 15 times, earnings, and this is a classic example of that.
Well, that's right, Roger. I just might chime in on that chart on Northern Star. It's interesting to note that in September last year, we put a buy on Northern Star at $7.72. And this stock has actually gone up in value by about 50% since that time. So that highlights what you're saying, Roger. If you had invested $10,000 in this stock at our initial buy price, you'd be sitting on about 160,000 today, and that's what Roger's referring to, viewers, in respect to becoming a millionaire. If you invest wisely in good quality stocks in the right sectors, and we'll help you and guide you with this, then you will make significant profits and be well on your way to becoming a millionaire, a multi-millionaire, obviously, if you've got larger sums of capital. Warren Buffett, recognized as the world's best investor, basically follows the maxim of buying and holding, staying in the market for the long term. And basically, we follow very much those principles, Roger.
Absolutely, we do. And always says, invest in yourself and invest in your education. And I guess the 300 odd people watching this webinar today, thank you for taking your time today, because you obviously invested your time in learning a little bit from Fat Profits, our views on the market. Maybe you'll pick up some ideas from today. So kudos to you for taking the time out on this day. Now, moving on to the next sector we feel will also help you in the long run is lithium. Now, Colin, you know all about lithium because this is very close to your heart, because lithium, you speak to a lot of investors who've been investing in lithium. They've made tremendous gains, but I might just lead in to say lithium price, if you look at the last sort of 3, 4, 5 years, you will notice that, yes, it's gone up dramatically because of demand, but also we've seen a 50% retracement in the last few months, and that has pulled some of these prices down for lithium companies. But as we said earlier, this volatility brings opportunity. So if you've missed out in the past, well, you could get a second shot at this. So over to you, Colin, to touch on lithium and one of our companies.
Yes, I will. And before I talk about one of those stocks, Roger, I might just talk in a general sense about the transition of the worldwide motor vehicle fleet from fossil fuels to electric. And Roger, you know yourself, I've had 15 years automotive experience with some major manufacturers, and I do know that the worldwide petrol engine fleet is absolutely massive. And so the amount of demand that will come through on the back of lithium, which is a central mineral needed for the electrification of vehicles. So we do see lithium is a wonderful mineral, wonderful material, wonderful resource stock that will be having increasing demand in the years and decades ahead. So Alchem is a stock that we particularly like. It's the world's 5th largest producer of lithium. And so Alchem is a stock where it's performed incredibly well. Its revenue is up 209%, Roger. I mean, that's massive. Yes. 557 million. If you look at their earnings before tax and depreciation, 311%, 401 million, Roger. That's a $500 million almost in profit. And net profit after tax is a very tidy 219 million. So there's a well-managed stock, a well-managed company. You look at the growth of the share price there. Our initial buy was at 171. We bought again at 456. You can see how astute Fat Profits is with some very strategic buys. Another one at 986. We do have a tremendous faith in this stock to do well in the longer term, Roger.
Yeah, very good, Colin. Well put. And look, just one more highlight here is, again, early bird catches the worm. Yes, if you missed out on any of these companies, look, we can always find, there's always some opportunities as long as you've got an open mind and you're ready for some quality research, whether you do it yourself or you get help from a company like ours. But $10,000 invested there only a short time ago, which is only just under 3 years ago, would be worth 7.5 times your money today. So if you put in $100,000, you'd be looking at $760,000 today, and vice versa. So these are not small numbers. They can change some people's lives, But again, you need patience. You want to get in early, and you want to do your research. So part of the millionaire mindset that we're driving home today, because this volatility in the markets that we're seeing at the moment will bring out opportunity. Now, we'll take a few seconds to tell you a bit more about fat profits, because some of you may be familiar. With Angus Geddes, he is the owner, the fund manager, the CEO, and the CIO. So he's the man behind the company. He opened this in 2000 back in Sydney, but we've also got offices in London and Auckland. We are a stock market research firm, so we provide research to mums and dads out there for Australian market and overseas markets. So depending on your level of interest, you can take out a subscription where you pay an annual fee, which is very nominal, and part of that subscription you'll receive daily, weekly, and monthly updates, both on the ASX and overseas. You'll get stock recommendations and buy, hold, and sell, a bit similar to what you've seen just now with Northern Star and AKE. You'll also get lots of dividend stocks and mining companies. And of course, you'll get webinars and podcasts, and you can call and email, and we can provide you the research. Now, apart from Angus, Colin, we also have people like David, who you know quite well. David's been with us for over 12 years in the business.
Yes, he has, Roger, and he's got a tremendous background in the resources sector. So David's broader experience includes time with organisations such as Colonial Mutual Life, Norwich Union, Australian Casualty and Life, also with Suncorp. Look, he held very senior positions, Roger, portfolio manager and fund manager. David is actually seen in the Australian stock market as really the guru on resources. He's got a tremendous background across the whole range of different resources stocks, from gold to silver, nickel, lithium, zinc, the list goes on. And David really is the man. He is the go-to man in the resources sector.
Sure, absolutely. And finally, we also manage real money. So here's an example of our performance of real money. So the orange line is where Fat Profits Australian share portfolio. The black line is the ASX 200, and you can clearly see from early days, and we've actually gotten better and better over time, and our outperformance versus the benchmark is nearly 3 times. So we've beaten the market nearly 3 times over a long period. So that's really just proof of our performance. So we're very proud of that. Now, moving on to some more stock tips for you today and some opportunities to make money. We're going to talk also about the real estate investment trust. So, Colin, over to you.
Yeah, this is a very interesting sector of the market. It's quite a large sector. So by way of explanation, real estate investment trusts are pooled investments, and they're unitized, typically in very large office, commercial, and industrials. They take in shopping centres and very large developments. These large investments are broken up into units of smaller value that can be purchased by private investors who become unit holders. So REITs are a sector that we have got a special interest. They're on our radar this year, Roger. We do think that REITs will do well in the rebound in the market in the second half. And there you can see that we've got a chart there. The REITs took a bit of a dip there in around about 2020, but rebounded very strongly. And that's the point that we would like to reinforce to our viewers today, Roger, that this actual sector, it did take a bit of a pounding, quite frankly, in the GFC. It rebounded very strongly. And just speaking to this slide at the moment, Moody's, one of the world's well-respected ratings agency, has obligations rated A, are considered upper medium grade. All 4 of our REITs in the Fat Profits portfolio are rated by Moody's as A rating. That's quite significant, Roger.
Yes, absolutely. So it's important to look at what kind of companies you're holding. And look, this particular chart also shows, yes, the REITs, which is the black line, the orange line is the ASX 200. So you can see, yes, that they've underperformed since COVID days. But we do think as this particular economic cycle plays out over the coming months, and we see an end to rate rises, the real estate sector will rebound. and we think these investment trusts will be a fantastic place to park your money. Will that time come in the next 6 months to 12 months? We think so. So we've got 4 stocks in this space, and we can certainly guide you if you're looking for that. The next space where you can potentially also make a ton of money, and look, some people have already made a ton of money over the last 5 years in Bitcoin. And if you, again, early bird catches the worm. So if you didn't get in early, you would have made some money. But having said that, we have seen Bitcoin pretty much fall off a cliff in the last 12 months from a highs of nearly 70,000 US dollars for one Bitcoin down to about 15,000 recently. So that was a big sell-off. We've seen a recovery in the last month or two. Now it's about 27,000. Will it get down to 12,000 US dollars where we see some support coming in? Well, if we think the markets continue to be volatile in the next 6 to 12 months, if we see a recession, if the Fed does not cut rates, and if the consumer stops spending money and takes money out of risky assets, then there is a chance that it may pull down a bit further. But instead of trying to time the absolute bottom of a commodity, we do feel that dollar cost averaging is the way to go. So if you're interested in Bitcoin and you are looking to get in, we feel that if you see some bottoms like we saw a couple of months ago at 15,000, having a few dips at it is probably a better strategy. So that's something to keep in mind. But just to be clear, we don't invest in Bitcoin at fat profits. As Warren Buffett says, you don't invest in something that you don't understand. If you're not clear on how it works, it's best to stay away from it. Just don't get caught in the hype. But moving on to the next sector now, where we also feel there are some opportunities now starting to emerge, but still probably a while to go, is financials. Now, having a quick look at the Australian financial sector first, yeah, you can see from COVID days when we saw a big drop, we've seen a decent recovery, some consolidation, and recent pullback because of what happened in the US and Credit Suisse. We do think the Australian banking sector is in pretty good shape. I don't think anyone would argue that our big 4 banks are in much better shape than our counterparts over in Europe or US. And one of the stocks that we do cover is NAB, National Australia Bank. And look, that's been a standout performer out of the big 4 banks. There's no doubt about that. It's gone up from $15 in 2020 up to $30, so pretty much doubled, gone beyond pre-COVID levels of $28, and still hovering around 28. Yes, we've seen a bit of pullback, but we may even look at buying some more if it gets down to that support line of $25, but we do like NAB. So if you're looking for one good name out of the big 4 banks, NAB is our preferred, but currently we don't have a buy on it. We are watching this space, and we may update that in the coming months. Now, moving on to dividends now. That's the other key component for self-funded investors. They want dividends. They want fully franked dividends. And Colin, for investors who are relying on dividends as income, we have an income portfolio which we update every quarter. So do you mind telling us a bit about this income portfolio?
That would be my pleasure, Roger. And as you pointed out, we have a lot of members and investors that are in the conservative investor profile space. In other words, a lot of them are retirees. And Roger, we know that retirees do rely on income from their portfolio to provide a stable long-term return above the index. And this is exactly what the Fat Profits Income Portfolio does. It provides a very strong return of about 13.7% per annum. We've pretty much done that since inception. That's well above the index. Most investors are happy with a 13% return from income, and so are our investors. You can see at the top of the chart there, we've got ANZ Banking Group, and it's had a very strong dividend consistently. There are some other stocks in there that we haven't mentioned, but suffice to say, Roger, this income portfolio is a basket of 22 stocks across financials, industrials, and property. You can see Nine Entertainment Group there, right in the middle. That's an industrial stock. It's got an outstanding dividend, Roger, 9.3% fully franked. We like now Nine Entertainment stock as a dividend stock, but also a growth stock. And you can see that the property stocks in this portfolio have got dividend yields as high as 6%. Now that's very strong. And some of the banking stocks, those yields for full year 24, Roger, up around 10%. So this is a very solid, good performing investment strategy for retirees and conservative investors. It's not completely a set and forget, but to a certain extent it is. You can invest in the income portfolio. You simply, as an investor or a member, you align the stocks in your portfolio to the basket of 22 stocks in this income report, and then away you go. You should get returns around that 13%, Roger.
That's it, Colin. Look, I know you and I are not retired yet, but I can tell you that if we are, when we retire, if we can generate 13.7% a year consistently from a portfolio, we don't have to look at every day, just buy and hold 20 to 30 quality companies on the ASX. And if we can generate, $130,000 a year from $1 million or more or less, that's 13% return. We'll be very comfortable with that. And part of that 13% is 6.5% in dividends, and the remaining is in growth. And that's what this portfolio has done. So I guess one of the key attractions for investors is to, when they come on board our service, they look at this portfolio in detail and they line it up, as Colin said very well, they line up our portfolio next to yours, and you try and cross match and see which ones that you like the look of and maybe you want to add to your portfolio. Now, the other thing is we don't just tell you which stocks to buy. We also have got plenty of stocks that we tell you when to sell. And here's a classic example of our recent sell recommendations. Some of these names you can have a look here on the left-hand side. You may be familiar with maybe Whitehaven Coal or a Domain or a Sonic Healthcare. Now, we bought them at certain prices. We sold them at certain prices in the last 12 months. And you can see the annualized return per stock. And if you'd invested $10,000 in each company, that's what you would have ended up with. Now, are we perfect? Do we get all of them right? Well, we don't. Does anyone get 10 out of 10 right? Don't think anyone does. Even Warren Buffett probably get a few wrong. But look, we do get 7 out of 10 right. That's our historical average. And if you can get 7 out of 10 right, Colin, I'm pretty sure you'll be pretty happy with that.
Well, exactly right. 7 out of 10 delivers significant investment returns for investors that are looking for a long-term stable return. Some of our investors make extraordinary returns well above 17%. We quote a 17% return. It's actually 16.7% right up to date at the moment, but we quote around 16 to 17% as the return on an Australasian equities report. But Roger, we do know, and speaking to members as I do on a daily basis, some of our members are making double that by strategically looking at the sectors that we alert you to. We also alert you to the stocks within those sectors. You can see there, we've put up some customer reviews. You can see the first review, it says lost without them, and it really sums it up. And this particular customer says, look, I've run my own SMSF for a number of years, would have been lost without fat profits. The information that I receive is what I use. I've entrusted to super profits, and in the morning tea, I religiously read the daily fat chat. So another one there underneath, Alan Jones from Perth in WA. By the way, we have a number of very successful WA members. David Campbell from North Queensland. He's been a member since 2009. He recently extended his membership to Platinum. Platinum is our top tier. He does consider himself a sophisticated investor. He also considers David Lennox a guru. He sees the enjoyment value, and he really appreciates the personal attention he gets from our team of account managers and from the entire Fat Profits team.
Absolutely. Thanks, Colin. So look, you can do your own research, and you don't have to take our word for it, but at the end of the day, people do communicate in the community, and you can see a lot of our members. Now, a few things for you before we talk about something more in today's webinar, and really the idea is to look for opportunities, but as Colin said earlier, our annualized returns over 22 years, a very, very long time, is 16.7% per year. Now, there's nothing to sneeze at. We are very proud of that, and look, we're not going to shy away from the fact that we've done very well. And you know, if you've done well as well, if you've done 15 to 20% returns over a 20-year period, you'd be telling all your friends about it. I'm sure you'll be telling your neighbors about it. And look, we're in this business. So, you know, one of the other things which helps members is it saves you time on research. We do the research for you. We also have got a lot of experience management, but you've seen some examples of. We've got 7 out of 10 winners, and that is very good performance. But we give you the guidance, we give you the views, provide you direction on a daily basis. The other key thing which our members love, and I might joke about this, but on a serious note, quite a lot of members that we have are also members of other services, and they tell us, and I'm not going to name any company, but they tell us that there are a couple of companies out there who constantly bombard you with a lot of emails trying to sell you other products that they offer. One company in particular have got 16 different products, and you know probably which one I'm referring to, Colin. They send you a lot of long-winded emails and ask you to upsell. So we don't do any of that, and we also manage real money and put our money where our mouth is. So Colin, over to you to expand on that. Yeah.
Look, thank you, Roger. I will expand on that, and thank you for bringing me in on this point. And look, I've had over 25 years experience in financial services with major financial corporations as a self-employed financial advisor. So I know a little bit about this area. What Fat Profits can do for you as an investor and a member is save you an enormous amount of time on reading, researching, listening, analyzing. We do very high quality research for you to save you time, and all you need to do is tune into our webinars. They're twice a week, once on a Monday and once on a Thursday at 12 o'clock. The webinars are really the jewel in the crown of the Fat Profits service. We're experienced, we're reputable. We do get 7 out of 10 right. And for today's webinar, we've got just a little bit of a description there on the various levels. Standard is your entry level, you get 1 report. Premium, you get 2 reports, you get the account manager benefit. Members choose premium. It's our most popular bundle, Roger. They typically choose Australasian equities and global mining. You do get the account manager benefit. That's very valuable. Top tier membership is platinum. You also get access to global equities as well as Australian equities and global mining. Once again, you get the account manager benefit, and that's our top tier. That's for sophisticated investors with large portfolios.
Thank you, Colin. So just to expand on that as well, because we're getting a few questions coming through now. So one of the questions from Helen is about mining. She's saying, I'm quite interested in mining. I think the research that I'm currently receiving for mining is not up to mark. So what does mining include? So I'll just explain. So if you, let's say you take on the premium membership, you'll get the daily emails, market commentary every day in the morning, 1 email per day. You'll get the 2 webinars per week. Mondays, we do a webinar for stocks. We cover 10 stocks on the Monday webinar and give you the buy, hold, and sell. And Thursday webinar is with our CEO, Angus Geddes. It's the best webinar you're going to find in the market. Angus comes once a week as the only fund manager we know in the Australian market, where he will come and talk to you directly via a live webinar on every Thursday. And you can ask him questions about the markets and what's moving and where's his positioning, and that is a must for you to watch. Now, don't forget, you can replay the recording. You don't have to watch it live. We record all the sessions and we email them to you. And on a Friday, you get a reminder of any highlights. Now, to Helen's question, the 3 reports we publish is Australian equities, which covers the ASX, a little bit of New Zealand, and also a little bit of Asia, and gives you the stock picks in this market on a daily basis. So we do real-time publishing every day, and you will get an email each day about a couple of stocks. The mining one, to answer your question, Helen, the global mining, that covers everything mining, jam-packed with small cap miners, mid-cap miners, and your blue chips like BHP and Rio. All things mining, from gold to silver to iron ore to lithium, nickel, rare earths, copper, zinc. It's all things mining. You're going to have a lot of stock picks in there, and you can find the next Allcam or the next Northern Star 7 times or 10 times your investment. So that's where you can find real growth. And global equities is really international stocks in US, UK, and global markets. So if you took a premium membership, you can pick any 2 out of the 3 reports and the account manager. Platinum will get all 3 and the account manager. Standard will just get 1 of those, but no account manager. Now, before we explain the prices to you, the one last thing I will add is really by joining Fat Profits, you are doing yourself a favor in terms of you're investing in your own education, you're investing in your future earnings, and as Warren Buffett said, this is really the best investment you can make in your own earning and your future earnings potential. Now, having said that, this investment is tax deductible, but speak to your own accountant. We can't give you the advice, but most of our clients use this as a tax deduction, and we can invoice that to your self-managed super fund. But Colin, if you can run us through these very nominal prices, because we've got some very special promotions today.
Well, exactly right. So those viewers fortunate enough to be tuning in at the moment are lucky because they're eligible to receive what we call a 2-for-1 special, Roger. That's 2 years membership for the cost of 1. Now that's quite a significant saving. So if I can draw your attention to the premium product, the normal price for 1 year is $19.95. And what we're doing for the viewers of this webinar, we're putting forward a special offer at just $9.95 per year for 2 years membership. And so that's a very good offer. Even at 3 years, Roger, it drops down to $895 a year, bearing in mind that 1 year is normally $19.95. So these are very strong offers. You can save potentially thousands of dollars by taking up one of these offers. And as I said before, those fortunate enough to be viewing this offer, you are eligible. So please get in contact with us and we can put these fabulous offers in place. You can see with Platinum, the normal price, I should say, for Platinum 2 years is $3,995, but if you take up this offer, it's just $2,595, a significant saving. And we certainly welcome all of those people wanting to save some money on the membership and get you started on this journey to become the next millionaire.
Absolutely. Well, that's what we were offering here. So what I'm going to do is open up a registration question now. So for those of you, we know there's always about 8 to 10% of people watching the webinar, and we will be just upfront with you now because some people for sure who are open-minded and willing to invest in yourself, you will register for one of the options and we will work with you. And we've got 25,000 members, so of course most of them started their journey with us through something along these lines or an email. However, if you're tossing up and you're working out which one would suit you, you can tick the 4th option. I'd like to discuss it a bit further, and we can give you a call or shoot you an email, and we can clarify any things for you. Now, I'll take a couple of questions here. This first question has come from David. He's asking about the account manager service. He's saying, what is the role of the account manager, and how will I benefit from that if I choose the premium service? Colin, maybe you can answer that, please.
Yeah, well, thank you for asking me. That's a perfect question. And the answer is simply this. We do provide hands-on guidance. We offer a personalized service. We work with the new member to help them firstly set up a watch list of stocks in the sectors that we like, and those good quality stocks that we believe will perform very well in the next 3 to 6 months. And so initially the idea is to set the membership up with a good price and support it with good quality backup. We do regular service calls. We're available 9 a.m. to 5 p.m. Monday to Friday, so you can call us on any issue. We're also able to help you with some general information, general feedback on the stocks that you hold in your portfolio that are not in our reports. And so that is the account manager benefit, Roger.
Very good, Colin. And look, you're a senior account manager with Fat Profits. So if you're watching the webinar today, you can get a guide of Colin's experience. And as you've heard already, he's got a wealth of knowledge through many, many years in financial markets. So if you have someone like Colin to work with, you can only imagine you'll only get benefits out of that, nothing else. Now, coming back to another comment actually just comes through from Jonathan. He mentioned that it's actually quite funny because Jonathan says, I'm actually one of those guys who's been in our database for many years, and I've watched many of your webinars in the past. So I'm what I call myself as a procrastinator, and I love to sit on the fence. But today, you guys have actually done a good job, and I'm convinced that this is now the year 2023 for me to take some action and join Fat Profits. And I'm interested in joining up with the premium. I agree with the panel on the forecast for the upcoming sell-off and an opportunity to make a tremendous amount of money. So thank you, Jonathan. We appreciate that, and we look forward to working with you. It's only taken a few years, but sooner rather than later. That's fantastic. Good to hear from you. But look, I might say there might be quite a few other people, and you might be one of them listening in right now, who may have seen these webinars before, who may have thought about it, but they haven't done anything, and maybe even spoken to us in the past, but haven't done anything, and maybe just continue to watch the free webinars and get some information. Look, free webinars will never make you money. Let me be straight up. They never make anyone rich. We can only provide so much information, but after that, our hands are tied. But really, if you want to come out on the other side of the fence and come inside the gym, if you like, because you can stand outside of the gym, you're not going to get a six-pack. You have to walk in. We have to work with you, give you a guide, give you a plan, and motivate you to take some action. And that's how you're going to get the right health. That's how you're going to get those biceps or the six-pack. And really, Jonathan, congratulations. If you are willing to jump on board, this is the time to get that money moving and working hard for you. Now, I am going to close this now because I think we've got enough registrations on these three options we've got. And just while we do that, is a quick reminder of the prices. You can see them now. 2 years for the price of one. If you choose the 3 years, look, less than 1,000 a year. I mean, you're not going to go wrong with that sort of price. If you're still thinking about it, well, let us know if we can do anything to help you. But Colin, anything to add before we wrap it up?
No, not really, Roger. I think you've covered it very well. I'd just like to thank you. It's always a pleasure to do these webinars together with lots of information for prospective members to consider. We always love to welcome new members on board, and you'll get first-class treatment from Roger and myself and the team.
Great, thank you, Colin. And look, if you have any further questions, please email info@fatprofits.com.au or any feedback. If you enjoyed today's webinar, got something out of it, look, we are welcome, and we look forward to working with you at some capacity. My name's Roger. Thank you for your time today, and we wish you the best in the market.